Now, returning to our top story, and stocks falling heavily following the global rout of the Dow, finishing off, well, 1,000 points, 2.6, but it's the Nasdaq, which had been more than 6% down at the open, closing down 3.5%. The reason, of course, two factors primarily. The labour market is slowing, and there are concerns the Fed has waited too long to cut interest rates. You then have the fall in Asia overnight, the carry trade, etc., onwards and upwards. The Fed must now be on the lookout to keep the economy from entering a downward spiral. Think about it. Markets are falling, then financial stability deteriorates. That causes job losses. People have less money. Companies laying off people. Workers can't afford to pay bills. They get laid off. That in turn creates and unleashes more fear, more market chaos. That's how the cycle goes. Nathan Sheets is the global chief economist at Citigroup. He used to be, of course, the top official at the Treasury. Avoiding that cycle, bearing in mind, Nathan, to a large extent, the economics is baked. Whatever the Fed does now, it's going to happen from the last 6 months to 9 months. But avoiding the downward spiral, how do they do that?
I think clearly the Fed has got to move aggressively. And I think that means 50 basis points of cuts at the September meeting, further cuts through the remainder of the year thereafter. And I think between now and the September meeting, which is about 6 weeks away at the moment, the Fed's got to be signaling that they're on the case. They're watching the economy, they're watching the markets, and they're prepared to do what's necessary to provide support.
Okay, but what an admission, not of just, that you're behind the curve. You stand in front of everybody, and last FOMC, no need to cut rates. We're still watching very closely. Within weeks, you have one has so misread the data that you end up cutting 50 basis points.
Richard, I think clearly that if Jay Powell was allowed to do a mulligan and he could get in a time machine and go back to last week, that he would certainly start the cutting cycle at that last meeting. And they were backward looking. They saw an economy where there was still more inflation than they wanted, and have been surprised by the weakness of the labor market data and the sharp turn in market sentiment, which is, you emphasize, really is a first order risk to the outlook for the economy at this stage.
Okay, but here's the problem. Get your 50 basis point cut and maybe a couple more before the end of the year. And you do risk, when I say stoking inflation, I'm not suggesting it'll roar up, but you do negate the ability to hit target.
Whenever the Fed has to make these decisions, they have to balance the risks. But I think we've seen enough slowing in the economy at the moment, and what we're likely to see in coming weeks and months, that there is scope for Fed policy to be a notch less restrictive without significantly jeopardizing that 2% objective for inflation that they want to achieve. So I'd be more sanguine on that side of the mandate right now.
How do they avoid the criticism that they're rescuing the market, the Greenspan criticism, the Bernanke criticism?
Honestly, I think when you're doing good monetary policy and you're responding to the economy, you're always going to be vulnerable to the charge that you're creating a Fed put and you're moving to bail out the market. And the Fed isn't happy about that. The Fed doesn't like that perception. But clearly, the worst outcome for the Fed would be to allow the economy to further deteriorate in an effort to avoid the perception that there's a put. So it's kind of a catch-22 for them, and they just keep their eyes riveted on the data.
Okay, Nathan, let's end on a positive note. Give me a reason or a thought about why this is not a market meltdown crisis.
Let me give you two reasons. First of all, when I look at the structure of the US economy, and when I think deeply about the ongoing AI revolution and the standing of the US economy in the global economy, US looks very strong. And then the second point that's positive, I'd say is more a cyclical point. And when I look at the data right now, I see a slowing economy. I see a loosening labor market, but I don't yet see signals in the data of a full scale downturn. So I think there are both cyclical and structural reasons to remain optimistic.
You've had a busy day, sir, and I'm grateful that you found time to talk to us and put to perspective. Nathan, always good to talk to you. Thank you, sir.